All right, we didn't quite get the jobs report that we were looking for, but the market really only, the negative reaction to that report only really lasted for a little bit of time. The market spent the rest of the day, pretty much most of the day, just filling in the gap, the post-employment report gap. The employment report shows the employment sector is very strong. Wages are still very strongly, are still very high. Of course, that's the biggest part of inflation right now, that the Fed seems to be worried with, because of how low the unemployment rate is, and that stayed down. So the markets checked that, but there were some interesting moves. There were significant moves in long-term bonds and in the dollar here recently. So we're going to break down how big those moves are and how, the ramifications of their moves that they're having, and the reversal potential that those things have been having, considering that they've been big drivers behind this risk appetite move demand that we've had over the last so many weeks. So we'll break that down. Our trade idea is a stock that's kind of stuck in the middle of, it's been on a nice good rally as well, but it's rallied up towards kind of a middle zone. So we'll take a look at how to trade that, to see how much support or resistance it has, and how likely it is to actually trend somewhere, and we'll talk about that trade. So let's go ahead and get started. Today is Friday, December the 2nd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Also click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. You can see we've had a lot of new clients here with our Black Friday sale. Some of our more popular resources, premium resources, are posted here. Come down on the bottom, click on this heart. It opens up this tab. Hit that like button that pops up there. Also, same thing here. Click the thumbs up icon. It opens up another new tab. And hit that like button as well right there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So we really appreciate those who like and share, retweet, and comment on our social media posts. All right, let's take a look at the S&P 500 here with the market forecast indicator. As you can see, after we got the cluster on Thursday, we opened on Friday down with that jobs number, then rallied throughout the day. Still finished the day down 0.1%, but well off of the low point. So that actually kept the near-term line in the reversal zone, though the momentum line did fall down. So again, this is kind of the expectation. You expect that the near-term line will follow suit and bring that the momentum line will bring the near-term line down with it. Of course, this doesn't always happen, right? It doesn't always happen. You can see there will be times where we can just bounce right back out of it. In fact, this is not quite a bullish intermediate confirmation signal, but pretty close. The momentum line's got to get down into the reversal zone for technically, and then ideally, like we saw over here, you want to see the near-term line also in the reverse, or at least down into bearish territory, like we saw back here on the 29th. Obviously, that day was the Powell speech, so it rallied that day. I mean, so that makes that signal look really, really good. But the reality is, you don't ever know when something like that's going to happen. But the idea is that the short-term technical environment was conducive to a bounce, maybe not that strong of a bounce, but to a bounce. And ultimately, of course, it got that bounce here, and now we'll see how much longer we can actually stay up here. If you take a look at the Dow Jones, which remember has been more bullish, also got that cluster on Thursday. Also finished with finished with an update about a tenth of a percent to the upside. Again, momentum line not nearly as bearish. So again, well off of the lows. Looking at the NASDAQ 100, which has been the most bearish, it also got the cluster on Thursday. Also finished down 0.4%. And you can see the, still kind of, flirting with this 23. It was at the 23% retracement there of the year-to-date decline. It got up above it and opened up below it Friday before finishing just slightly up above it there. So And then finally your Russell 2000. You take a look at your Russell 2000. Again, it's sitting at the 38%, and 62 is sitting at some resistance here. Much stronger day on Friday as it rallied up well off of its low. So the momentum line's not in the reversal zone at all, and the near-term line is still easily in the upper reversal zone, just like on all the other indicators here. So really good move. Strong bullish posture across the board. Dark green shading and a green line on the market forecast. So we're still trending higher. The momentum line is out of the reversal zone on the Russell 2000. The market sentiment, The market sentiment is also barely out of bearish territory, 40.39 there. Of course, it's higher on the Dow. The NASDAQ is still in it, down to the 28th percentile, and then your Dow Jones Industrial Average is in the not only out of bearish territory, it's actually almost in bullish territory. It's above the midpoint of the chart. So again, showing how bullish the on a relative basis the Dow has been. If you take a look at the weekly chart, here, you can see the near-term line still at very strong levels above the 90th percentile. Near-term line, intermediate line is crossed up above 50. So we have dark green shading. We don't quite have the green line. We did get dark green shading back here in April. We had already rolled over by the time we got it. So we hadn't rolled over enough. So we still were rising, but we did get 1 week there. So a little, better. We weren't as far above the moving average then. We were already back down below it by 2.5%. We're actually exceeded this week, finally getting above the 2.5% mark on the S&P. I remember on the Dow Jones, which has been a lot more bullish. Of course, the intermediate line is actually in the upper reversal zone, right? It actually closed above the 80th percentile with the near-term line way strong. And you can see what the candle looks like there, a little bit of a hanging man type candlestick pattern, long lower shadow. Long lower shadows are bearish, they're not nearly as bearish as a long upper shadow. It means the bears are around. It just means that the bears didn't finish the week with the, on the plus side. The bears started the week, or at least had, showed up during the week, but the bulls finished the week on the upside as we rally up, to the close. If it was a long upper shadow, that means the bears were there, and they were there at the end of the week, and then closing it back down towards the low point. So it's bearish. The bears were there, but the bears didn't finish the week with the upper hand. The bulls hung in there and ended up finishing the week with the upper hand themselves, holding on. So we'll see, again, if the bears are now, leave again, and we get these nice, good, bodies, candlestick bodies, or if this is a, sign that the bears are going to be sticking around and still battling it out from week to week. Obviously, you have dark green shading and a green line there. The NASDAQ 100, of course, on the other end of the spectrum, we still don't have, the intermediate line still in bearish territory. It's on the weekly chart. We still are not above the moving average. We're right at the moving average, and we are literally right on it. That's with the 0% mark there. So we're not quite. When we actually did get above it back over here in August, we were just barely below it there in March. So we'll see if we finish the week. Now let's go one more chart, since we did finish the monthly chart here a little bit ago. So this is the December so far, but if you look at the monthly chart for November, again, you can see the bears with the long lower shadow, the bears were there, or the bulls were there, and they finished the week with the upper hand, or the month, with the upper hand. You can see the near-term line getting up to one of its higher levels of in fact, the highest level of the year, the near-term line on the monthly basis. So now, that's this week's. As of right now, this month, we're only a couple days, 2 days into it, and we already have the near-term line. So we'll see how that finishes. Of course, again, it's not common for the near-term line to precede the momentum line. Usually it's the other way around. So it's that same phenomenon that we've talked about before. That's not necessarily, what we kind of want to see when we're trying to break through and break out of this mess that we've been in. Looking at the long-term chart for the S&P 500, you can see almost closing. Oh, actually, we did close. We ended up closing just a smidgen up above the 40-week exponential moving average. Good, strong Hakunashi candle. PPO is rising. So really bullish candle from that perspective. Of course, your Dow Jones, we already got the crossover, right? I mean, again, if this were the S&P 500, we would be bullish as can be. I mean, this is exactly what you want to see. Not only are you above the 40-week and have been for now 5 weeks, but the 10-week is now above the 40-week, and they're both rising. The 40-week is actually rising there. PPO is positive and rising and looking really good. On the other hand, your NASDAQ 100, you can see is coming down here. Your NASDAQ, let's see here, let me change this. Your NASDAQ 100 is not above the 40 weeks, not even close to the 40-week moving average, but you are above the 10-week. It's rising. PPO is rising. You got some bullish candles. You did get a little bit of a long lower shadow. So after getting the lower close last week, we ended up with a higher close up above that body. So, another good bullish reversal there. And then finally, your Russell 2000 is just kind of going really, really slow. See, I need to get this saved as well. It's got some really small ranges. Also the lower close last week, and then reversed with a higher close this week, but with a upper and a lower shadow. So we'll see how that plays out. You would expect, again, it's a transition when you have the higher and the lower shadows. So you would expect that it would show up in a potential reversal next week. So we'll see if we end up getting another lower close or not. All right, let's take a look at the 3 green arrow charts. And of course, we have 3 green arrows on the S&P, the Qs, and IWM now, but not yet on the Dow. And the Dow has been the most bullish. And you still have the red arrow on the MACD. The MACD won't get positive. So when you look at the 2 line versions of those charts, you'll notice here that, again, the S&P looks bullish, even though the MACD did barely get back above its moving average. But you can see this isn't like the 3 green arrow type pattern that you'd think, ooh, we're going to get a really good bullish move out of this. It's kind of stuck in this convergence mode. As you saw, the diamonds still are. At least everything is still above its 8-day moving average. Even the diamonds got up above it. But you can see how we're converging into this point of control, into these old high points from March and August. Looking at some of the other oscillators for the S&P 500, again, after getting the cluster, you still got a relatively, we are getting higher lows on the negative indicator down there, but your positive is still above 30. When you look at like the RSI and the CCI, we are above 60. We're not really like pushing up, but we are above 60. We did get back above 150 again. These are good bullish levels for the RSI and the CCI. The trend strength indicator has gotten to pretty strong levels. Again, 80 and 50 is the magic numbers. We're almost at 80, but we're not at 80 and 5, excuse me. We are still above the green line. We're above the cloud, so really, really good, levels. The Qs are not above its cloud, and there's no trend going. So it kind of gives you an idea that this is the biggest section of the S&P 500, and it's just lagging. Whereas your diamonds, which is not necessarily the biggest sector, but it's been the biggest outperformer by far, just absolutely destroying QQQ. So let's take a look at the Hull moving average, and you can see how bullish we are. But you can also see how close these parabolic SARs are, which means we're getting closer and closer. It's hard. It's easy to go up when there's a good space in here, but when there's not a good space, you're susceptible to the reversal on there. Again, the Qs are close to that as well. The diamonds actually did get a brief reversal here, and it's still set up for 1-2 with a really high level. Like we're way up above the 200-day Hull moving average there. When you look at the money flow, which is a big deal for us, again, you can see that the higher highs we've been getting since this peak here at the end of October. We've been getting higher highs on the index, but we've been getting lower highs here on the money flow index. And you can see, like, again, going back all the way out to like over here, this is this last time we've been trading at this level, at current levels, and you can see the volume is not nearly close to being to that point. And then also the other factor too is your McClellan oscillator. It ultimately did finish. It was down at low levels earlier in the day. It did finish at 45, But again, it's not, and you can see the summation up there is getting close to 500, but not quite breaking through. The other thing we like to look at is over here, the new highs and new lows index for, here, let's just go to this. Oops. I wanted the new highs and new lows index here. We did get positive on Thursday, up to 94, but we dropped back down to 12. So again, it's kind of that 100 magic number. The average is up. It's not up as far as it was in August, incidentally, but at least it's up here. So again, getting up to like above positive 100, as you can see, if I go out 5 years, that would be a really good level. The fact that it's still kind of matching these other small little positive levels that we've had multiple times this year, and at the very, very end of last year a couple of times before making legs lower. Those are all some things to keep an eye on. The skew, something we always kind of watch too, as when you're above the average, you get a rise in the markets, and you can see the skew is kind of not really extending away. We had a nice little peak, and we are above the average, but not really extending too far up away from that average. When you look at that in conjunction with, like, say, the volatility index here, be right here. When you look at the volatility index, you can see the VIX really dropped. So like complacency is at its highest level of the year. You can see we got down. Well, I guess in March we had a little bit of a lower level. We were just coming off of a pullback low point. But you can see, and we did get down to 80% in March, and we got only down to about 83.5%, and now we're down to about 83%. But still, these are low levels. You can see again the correlation of the VIX with the VVIX down at the bottom is at negative levels, which again is pretty rare and typically coincides with a move to the upside in the VIX. When you look at how far the VIX is away from some of its averages, some different multiple time frame averages, it's pretty low levels. In fact, if you look at how far away it is from its 50-day moving average, 50-day simple moving average here, lowest level of the year, right? I mean, well, going back to March, it is in the first percentile for the past calendar or 1 year, 52 weeks. So it is really far below that 50-day moving average, excuse me, and it doesn't appear to be turning over anytime soon. Like the histogram is actually still getting bigger, not smaller. We're not converging here at all. We're easily below that 8-day moving average and breaking below 20. So really important break to see if we actually end up staying below 20, because that's been a buy signal for volatility. So it's a sell signal for risk appetite twice so far this year. We'll see if this one ends up being the next, the third time that we drop below 20 and then rally all the way back up towards, at least above 30 on the way up to the upside. You can see the ATRs are down, the volume is down. So it's been a good run with smaller ranges. Now we're just kind of keep an eye on if and when we ever exceed those ranges. If I were to go over here, today's, we're at 86 million, and the range was almost 6 points. We filled in most of the gap, so almost 6 points there, so a little bit below the average, and just about at average. So the more that we get below that and get some smaller and smaller ranges, then that will get this back down below 1%, that ATR to price ratio there. Get it below 1%, and we'd feel a lot better about this trend sustaining itself up to new highs and beyond, right? Because again, this is a correction mode. That's any time you fill in the gap here between the 50 and the 200-week moving average, that's a correction. You come off that correction, you get up to new highs within months. So that's, again, it's unlikely that this is just a correction because it's already been 11 months. It's more than likely that we're probably going to end up peaking around this 50-week moving average, again, like we did already. Over here was at the 30, and this one will be like we did in August. We kind of peaked at the 50-day moving average, a little bit above the 30-week moving average. A little different here in that the MACD is more positive. The histogram is as high as it was then, but the MACD itself is more positive, and the 8 and 17 both appear to be crossing above the 30. So, but as of right now, still just filling in the gap between the 30 and the 50, and that's, again, until you break through it, that tends to actually be when there's that big of a gap between the 30 and the 50 there, and you don't break them both in the same week, then that ends up being just a kind of a gap fill, and there's resistance at the top of that gap. All right, let's take a look now what's driving this price action. You can see how the 3-month, look at developed market stock for the last 3 months, have really taken off here, up 12%, so the highest return. Emerging markets up 2%, the S&P 3.74, the Qs lagging behind. You can see real estate, the dollar now is one of the worst performing asset classes of an extended period of time. That's been rare for most of this year. Let's look at just how this week has gone. So let's go down to December. I believe we're actually in the last month of the year. This year's just flying by. Let's come out here to the 5-minute chart. And let's take a look here. Give it a second to load everything up. There we go. So we take a look here, and again, this is actually including Friday because it's kind of messed up here on the chart because of that half day on Friday. But again, you can see what's been the biggest loser by far this week has been the US dollar, and look at what's been the biggest beneficiaries. Emerging markets, gold, international, developed markets as well. These are big beneficiaries of a weakness in the dollar. Commodities actually did really well until the last 2 days. Right? They started off really strong. Again, beneficiary of the weakness in the dollar. But then commodities actually fell throughout the week, throughout the last 2 days, ended up down, which is interesting because gold didn't fall during the last 2 days. Emerging markets didn't fall. And treasuries actually rose. Right? The treasuries were down for most of this week. But from that day forward, if you look at from the last 2 days alone here, December 1st and 2nd, treasuries have been off the charts. Like the TLT has risen 4.25%, which means yields are falling. You'll see that in a second. The dollar down, commodities down, which is also not something you typically see. In fact, again, remember the three-headed monster for most of this year. In fact, if I go back to year to date, the three-headed monster here for most of this year has been dollars, commodities, and yields, right? With bonds being at the bottom. So that means the inverse yields are up here at the top. So bonds, commodities, and yields have been the three-headed monster that's been the biggest performers to the upside all year long. Gold is finally almost at break-even levels for the year. But then go back to just the last 2 days again, and you can see that it's flipped that script around. Now, yields and bonds and commodities are all down. Real estate's down. You can see the Qs were down for most of this week. Not down very much though. And IWM was up, but not up very much. So just for these last 2 days, pretty flat there, which is interesting because the dollar is not flat, right? You would think very strong weakness in the dollar would have propelled stocks strongly to the upside, but not necessarily the case. In fact, it was, again, TLT, which just took off like a rocket ship the last 2 days, Thursday and then Friday. And you can see now is well up, the highest it's been above this moving average all year. Big spike in volume yesterday. Pretty decent jump in volume, at least a little bit above average here today. Big ranges, well above the average range. Obviously, the 8 and 17 are above the 50-day moving average now. The 30-day is about to cross. When you look at the weekly chart, this is the first week we've closed. The TLT has closed above the 17-week moving average all year long. The last time it was above the 17-week moving average was back over here at the very end of the year. So it's been all year long that we've had this big of a, this kind of move, right? We're up to the 30. You notice we are still below the value area for the last 5 years. So this is a pretty good chunk of time. We're still in the low end of that area, so we're not out of the woods. We basically, if you go back to where we were over here on October the 17th, so let's go back to like October 23rd here. October 23rd of 2022. So that means we'll go to October 24th of 2021. So here's the 1-year chart, and you can see again just how far below the point of control we were, just how how we had broken below. Excuse me, this would be a weekly chart, sorry. And it would be 5 years. So it'd be 18. 2018. That's what we want to see. So you can see again just how far the point of the value area has dropped since. It included this node here. So if I were to go out, 5 more or another week, so 1 more week there, and I think I did 1 more week here. Yeah, 1 more week here. So you can see now how we bottomed out. We're floating our way up, and now go back to the 5-year weekly, and we have filled in a lot of that that gap. I mean, we were so far down. Like I said, the value area has shifted down. They contain this volume node, which has now become the point of control here. So you see how and you also see that we're right at the 23% retracement level, which, remember, once you get above it, actually starts the retracement. So all of this has just been kind of noise because, there's such a wide gap between the 0 and 23% retracement levels. So now the question is whether or not, this noise will continue to retrace. Again, this is one of the bigger volumes. If you go back to the last time we had a volume bar this big, so right about 2% there on the MACD, was the peak here on bonds. We had, we opened up that next week there in March 2020, but we never did continue. We really we started to converge, and then we just, went sideways there. We just lost the momentum. So this, needless to say, this is a strong level of momentum right now on bonds. And again, if you look at the dollar, which is your other big mover this week, it really broke down below the 30-week, broke down below that 38% retracement, down to the 38% retracement of this longer-term dollar rally, right, that we've had. So it's sitting on the value area as well. It's still sitting above the 50-week. If you look at the 1-year chart, we're sitting right at the 200-day moving average, again, right at that 50%, 38% retracement levels, just a smidgen below the point of control. So we're sitting at some pretty important support for the dollar, and again, this weakness has been relatively bullish for equities. Break below this would get us a good correction going on the dollar. Like, we would be able to get through, getting to the 30 and the 50 week is a pullback. By breaking the 50 and working our way down to the 200 week, now we're looking at a correction on the dollar. So as of right now, we're in the midst of a little bit of a pullback here. Obviously, it seems much a bigger deal than a pullback because the rally was such a bigger than normal rally. So you're going to have the pullbacks are just going to be bigger. The pullbacks are going to be like corrections. The corrections are going to be like bear markets. We've seen that in the S&P. Right? We had a correction this year, but that rally was so bullish going into it that it makes corrections seem like bear markets for a lot of people. And that's kind of what we're in right now. The dollar's in a pullback stage, and it's actually sitting at a support. And we'll see if that pullback continues. I don't think it will. I expect that we'll find some support here. I expect that the 10-year yield will find some support, like it being at 3.5%, when you had 100% odds that the Fed will be at 4.5%. Right over here. FOMC. So we should, I believe it's still 100% odds. Let's go to December. Yeah, we are at 100% odds that we'll be at 450% or higher. For February, we have 100% odds that we'll be at 475% or higher. In March, we have an 84% chance that we'll be at 5%. So that's, again, 50, 25, 25 is what the Fed's looking at. I think if we do get the 5, it'll be 50-50, and then they'll be done. But those odds there, you can see what that's done. Like our yield spread, if you look at the 3 month, the 3 months at 4.3. Remember the 10 years at 4. What is it? 10 years at? Let me refresh this page. We're at 4.28. The 3 month is higher than the 2 year. The 10 year is at 4.5%. That makes the 10 year to 3 month spread at 82 whopping basis points, which is just insanely low. And then you look at the 10-year and 2-year spread, and it's actually smaller at 79 basis points. So again, the 10-year spread, the 10-year note, is why I mean, again, we have 100% odds. So if we stay at 3.5% or less, that means the spread between the Fed funds rate, which is right now you have a negative 50 basis points between the Fed funds rate and the 10-year yield. The Fed funds rate's at 4%. The 10-year yield's at 3.5%. So you kind of get the idea that either this is going to continue to move lower, and we're going to be in a pretty and the Treasury market is pricing in a significant recession. Again, with these inversions, like again, the 10-year yield should be being sold off to park that money in higher yielding short-term assets to take advantage of their liquidity and their short-term nature. So the fact that they're not selling off, and not only are they not selling off, people are still buying it in droves and sending those yields lower, means the Treasury market's pricing in what may be a significant recession there, creating these wide inversions between the long-term yield and the short-term, which typically resolve themselves due to demand for the higher returns. Nope, people are buying the lower returns, and they're buying it again in droves, and they're buying it for a reason. And again, if inflation was the reason, they would be selling bonds. But if deflation is the reason, then you're going to be looking at people buying bonds in anticipation, in my opinion, of a significant economic contraction. There's been a lot of chatter lately about this ratio on Twitter. I've noticed about the lumber to gold ratio as a predictor of economic weakness, with weakness showing up in the real estate sector in particular. Obviously, it is. You can see the weakness, and you can see, 2018 to COVID, we had a drop. This 14 going into mostly 15 and 16, we had some declines. These are past economic slowdowns. If I were to go out further in time, let's go out to like 20 years and find that 2008, 2009 period. You can see the weakness coming out of the housing bubble. And then, of course, 2011 with the credit crisis correction there. And you can see the rallies. There's your 15, 16 correction. There's your 18 to COVID correction. And then now you can see the significant decline we're seeing here. And I talked about how the Dow has been outperforming the NASDAQ. Again, this is a significant move to the upside in the Dow relative to the NASDAQ. That's not typical, right? That's not typical. At least it's not typical with the idea that would be bullish for the markets. You can see QQQs breaking down, still right around the 200-week moving average, but below the 8 weeks still, the 8's below the 17, and everything is moving to the downside. So you still have the long-term PPO is also still moving to the downside here. So you got this significant move to the downside in this ratio, which again is not bullish for the markets, would actually be more bearish. So lots of signs that the market may not be as bullish as this little move has been showing us across different things. Let's look at the sector moves, and you can see the sector comparison chart over the last 3 months. Healthcare, industrials, financials, materials, energy, all your cyclical areas, not surprising, have been your biggest performers. Let's look at this the last 2 days. Let's go out to December 2022 and then look at the last 2 days alone. Again, this is kind of like, the dollar has been really bearish. Bonds have been really bullish. So if you look at this, you've got materials to the upside, but not energy. You've got industrials and healthcare up to the upside, but not financials. You've got communication services to the upside, but not technology or discretionary. I mean, these are not typical areas that move hand in hand with each other. And a lot of these other areas have been pretty bullish, like energy and financials and technology, and they were all down. Real estate as well, and utilities down here for the last couple of days. And if I were to go back all the way to for the whole week, go to that Friday. So you can see communication services, consumer discretionary were your big winners. You have healthcare up there as well, and then energy, which has been your biggest winner year to date, giving back some of those gains, and financials also lagging down for the last 2 days or for the whole week combined. So, not necessarily like a complete risk-on move in a lot of these sectors. When you look at the sector grid and see how they're performing here, you can see lots of dark green shading and a green line across the board, except for an energy, which again has been your biggest winner, and it's showing some weakness. And then now you look at the 12 grid for all the biggest economies out there, and the ETFs that track their major stocks here. And you can see again dark green shading and a green line across the board, except for in this case Brazil. So this is a broad risk move, but you also see a lot of clusters showing up here in the last couple of days, and last Thursday in particular, in different areas of the world, right? U.S., Japan, Germany, all showing clusters. France showing a cluster here recently. Pretty much everything relatively close to it. And there's Korea looking like it might be kind of double topping there, with everything else forming some divergent type high points here. All right, then let's take a look at our trade idea of the day. Stock like Delta, which has been on a good run, just like most everything else, but it's converging as well. MACD peaked a long time ago. The histogram peaked at the end of October. The MACD itself peaked at the end of October. We've been converging ever since, as we've been grinding our way up into that moving average, and really up into the middle between two important volume nodes. When you look at like its trend strength indicators, the DMI here, we had already peaked, but you see how we're getting lower highs, higher lows down there at the bottom. When you look at the RSI and the CCI, so this one here, you notice that we've also been getting lower highs here, and same thing with the CCI. So we're kind of converging. We're not really, breaking out significantly to the upside anymore. We are kind of sitting at the top end of the 4-week range. You see how much time we spent below the average, though. You can see how susceptible it is to that kind of move. And then looking at like the long-term chart here, we're right at that moving average. Looking at the, let's see, where is it? The Bollinger Bands for Delta. Let's take a look at Delta here. Again, into this gap in volume, and you can see, look at the Bollinger Bandwidth, how small it's gotten as we've sit, and still in the upper half of the quartile. The bands themselves are actually still inside of, so the bandwidth has come down so tight that it's brought the bands inside of the Keltner channels and hasn't really budged, right? And we're smack dab in the middle of this retracement area that Delta's been in for most of this past so many months. Again, right smack dab in the middle of that area. So that sets me up for doing an iron condor spread. So I would sell at the 20 Delta, sell the 40, buy the 42 over here, sell the 32, and buy the 30 for protection. That gives me this trade down here, depending upon where we get filled in at. If we were to get filled in at 55 cents, that puts us over here in my position size. For that normal risk, right around $1,000, and getting right around $385 for my reward. And you saw these break evens are sitting right here, so you are right at the top end. You have to get it clear that volume node and the value area to the upside, but also have to clear this volume node, which is the point of control, and more moving averages, all these moving averages down to the downside. We would obviously be trending, where this trade does not want to be trending. So we can take advantage of a stock that's kind of going sideways here as it's coming off of these low points and fitting inside of two real significant volume nodes there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your weekend, everybody. And we'll see you all next time.